Good morning, ma'am. I'm Divya and this is Minta, and today we're going to present to you our Ca1 Bacc concept map. Starting from the left, let us look at the introduction to accounting and business. Under business, we have language of business, which provides information for managers, creditors, owners, also known as business organizations. It can be split into three categories. 1. Company. It is owned by shareholders and has limited attached to the name of it. Example, Shi Lin Private Limited. The shareholders are not liable to top up for any shortages for repayment to lenders in the event of a bankruptcy. Number 2, we have partnership with at least 2 owners where the decisions and risks are shared. Number 3, we have sole proprietorship, one owner who makes all the decisions themselves. Let's look at the 3 types of businesses. First, there is the manufacturing where the company makes their own products like Bee Cheng Hiang. Number 2, we have services where actual services are provided for the clients like phone services and so on. And lastly, we have trading where the company buys and sells products. Usually they buy for a cheaper price and then sell it for a higher price for profit. Now let us look at accounting. The process of accounting includes analysis, summarizing, reporting, and interpreting financial information. There are 5 concepts that we have learned in chapter 1 and 2 that we have put together here. First, we have the accounting entity concept, in which owner and business are considered as separate business entities. Only business transactions are to be recorded and owner's personal transactions are to be kept separate. Secondly, we have the monetary concept, in which transactions are recorded only if it can be measured in a monetary term. No recordings of non-financial transactions like customer loyalty should be included. Thirdly, we have historical cost concept. Here, transactions of the actual amount paid should be recorded. The amount shouldn't be adjusted due to inflation or market changes. Fourthly, we have accounting period concept. It states the lifespan of a business that is broken into regular time intervals for which accounts are prepared, either monthly, quarterly, or even yearly. This is very important because based on this concept is where internal and external users make informed economic decisions. And lastly, we have going concern concept. It assumes that a business will continue to operate in the future unless there is evidence, like maybe lack of cash flow, indicating that the business is about to cease. Now let's look at the equation. Accounting equation is assets equals to liabilities plus shareholders' equity. Assets is basically the properties of values owned by the business like cash, furniture, office equipment. Liabilities is the debts owed by the business to outside parties like bank loan and accounts payable. And shareholders' equity is the owner's claim on net asset of the business. Company issues share in return of investing cash, like the revenue and the expenses.
The double entry system allows the business to record transactions in an organized manner in the general journal. The accounts are then posted to the general ledger and goes through the accounting cycle.
Rules of debit and credit shows an increase and decrease in each item of the accounting equation. Values are recorded differently based on its category. For assets and expenses, the increase will be debited and the decrease will be debited. For liabilities, revenue, and shareholders' equities, it's the exact opposite. The amount will be credited when there's an increase and the amount will be debited when there's a decrease.
So the accounting cycle consists of 7 steps. The first step of the accounting cycle is analysis of business transactions, which uses a 5-step transaction analysis. The first step is to analyze the accounts affected, then classify the accounts into categories, and then you should check for the amount that the account is increasing or decreasing in and apply the rules of debit and credit. The second step is to record transactions in the general journal using the T account. Thirdly, the general journal entries are to be posted into the general ledger, which is to add all debit and credit balances from the general journal into the general ledger, and the end debit and credit balances should be equal. The fourth step is to prepare the pre-closing trial balance, which includes permanent accounts such as assets, liabilities, and shareholder equity, and also temporary accounts which includes revenue and expenses, but without closing the accounts, which will be posted into retained earnings. The fifth step of the accounting cycle is to prepare the financial statements, which is the statement of financial position and the statement of profit and loss. The statement of financial position is also known as the balance sheet, which includes permanent accounts, and the statement of profit and loss, also known as the income statement, includes temporary accounts, which are the results of business operations. The sixth step is to close the temporary accounts, which is to close all temporary accounts and post them into the updated retained earnings, which includes the retained earnings from previous accounting periods. And the last step of the accounting cycle is to prepare the post-closing trial balance, which consists of both permanent accounts and the updated retained earnings.